Hi guys, how are things? In this video I want to have a quick chat with you about split mortgages. We got a lot of inquiries recently through DMs and on our live Instagrams about a split mortgage. For those that don't know what a split mortgage is, a split mortgage is something that would have come around a number of years ago, especially after a financial crisis when people would have got into difficulty paying their mortgage. It was one of the solutions that banks would have came up to in order to keep people in their family home. And basically what it is it sounds what it does, it's a split mortgage. So what they did was, let's say an example where you have a €400,000 mortgage and you couldn't have the capacity to pay that back due to maybe losing a job, recession, etc. What the bank may do is split that mortgage into two pieces. So 200,000 we put into a normal mortgage structure where you pay it down on a monthly basis, so capital interest payment. Another 200,000 will be essentially parked in the cloud with the bank. And what that means is that it's just left there for the future. They review it every couple of years with you, but you don't pay it down and doesn't accrue any interest, or maybe a small amount of interest depending on the bank and depending on the agreement. Now, theoretically, what this means is that you're only paying down, in this example, half of your mortgage. So when you come to 5, 10 or 15 years, you'll still have this massive payment that you haven't really tackled over a number of years outstanding. Unfortunately, some of these deals would have ended up in non-traditional bank houses. So it would have been some what people would probably call vulture funds and other finance houses. And those rates tend to be quite high in most instances. So the 200,000 that you're paying down may be a situation where it's maybe a 4%, 4.5%, or maybe even higher, in around that type of mark. Other banks will have tracker parts still on their parked payment piece where you're paying down your payment. And again, some banks have a situation where the cloud piece is actually got a small amount of interest or no interest. However, we're getting a lot of inquiries about people seeing can they move from these non-traditional banks back into a normal bank, if you like, in order to try and get a lower interest rate and trying to put the payment back in and try and get the mortgage as one mortgage again. So back to a 400,000 mortgage at a low enough interest rate, because they now might be on track because it's nearly a decade since they might have been in trouble. There are one or two banks that will look at this, okay? So if you have a split mortgage at the moment, highly recommend you reach out to us for a mortgage consultation. We can go through all the figures and let you know whether it's going to be practical or not to try an application to move your full split mortgage to a new lender, probably at lower interest rates, and probably giving you the chance to get back on paying your mortgage so it's cleared by the time you get to retirement age. A couple of things to watch out here for is going to be what's called the repayment capacity. Let's say you had a split mortgage agreement, and let's say it's with Pepper for argument's sake now, and you're paying Pepper back on the smaller part of the mortgage. They're paying back, let's say, €1,200 per month. In that instance, if you're going to go and move the full 400,000 to a new bank over a 15 or 20 year term, your repayments might go up to 1,500 or 1,600 euro, but obviously your mortgage or full mortgage is coming down over time. If this is the case, you need to be able to prove to the new bank that you can afford the higher repayment, i.e. that 1,500 or 1,600 euro. So you're sorted on the first €1,200 because you're paying it back to Pepper on a monthly basis. So you'd want to show as affordability over a 6 or 12 month period for €400 or €500 per month to a savings account, credit union, or post or somewhere like that. And that shows when you go to the new bank that you can afford this new repayment and you're more likely to maybe get through the process. Another thing to look out for here is going to be your income. Obviously, if you have, say, a €400,000 loan outstanding, you're going to be looking at maybe the 3.5 times salary rule, and therefore you're going to probably have a combined income of over €100,000. So again, the normal rules will apply at 3.5 times your salary, and making sure that you have a good loan to value. You know, you want to be under that 90 or 80% loan to value as well. For most people that would have bought maybe in towards 2004, 5, up to maybe 2009, they, in my opinion, should have, depending on where they bought in the country, they should have their loan to value in a good enough shape now as well, especially over the last couple of years' growth in the property market. So just to recap there, guys, there's three things to consider. First is the repayment capacity. If your new mortgage is going to be 13 or 1400, say 1,600 euro rather, and your existing mortgage is 12 or 1,300 euro, you're going to need to save a little bit more over a 6 or 12 month period to prove the new bank you get paid. The second thing is going to be your incomes. You're still going to be judged on that 3.5 times your salary. And the third thing to look at here is going to be the loan to value. So making sure you have a loan to value below 90% at a minimum, but the better the loan to value, the more likelihood that deal being done with the new bank is. I do know it's very stressful for people that might have been in financial difficulty with a mortgage before, and I do understand how you might be a little bit afraid to open communication and actually reach out to somebody to try and get a plan in place. That's what we're all about here at Ask Paul, trying to put those plans in place to make sure people's finances are in order, not only now, but in the future, and making sure you have a plan in place to clear that parked mortgage. Because if you don't, when it gets to the end of the term, the only likelihood is to sell the family home and pay the bank back and downsize. And not many people want that option. So please, if you're in this situation, book in for the consultation, give us the figures, and we'll be able to tell you honestly whether it's a runner or a non-runner for you to change from a split mortgage back into a more traditional type mortgage and get it paid down. Hope this has added value as always. If you feel you know somebody that needs to watch this video, please tag in below and let me know what you think. Have a great day.